Contrary to what a lot of people mistakenly believe, poverty and inequality are not the same thing. Simply put, poverty describes a situation where a person doesn't have enough money to meet his basic needs, with the two main poverty types being 1. Absolute poverty, where we set a certain income level and say that those who earn less are considered poor no matter where they live. The World Bank has such a poverty limit, which was last updated back in October of 2015 and currently lies at $1.90 per day. 2. Relative poverty, which is location dependent and basically describes a state of not being able to afford your basic needs when it comes to your location. For example, someone earning $5 per day might afford the basics, including a place to live in many African countries, but not in Germany. So the relative poverty threshold is higher in Germany. In contrast, economic inequality refers to income, wealth, or anything else that is distributed unevenly. As an ultra-simplified example, we'll assume country A has 100,000 citizens, with 50,000 earning $1 per day and the other 50,000 earning $2 daily. In other words, 50% of country A's citizens live below the World Bank's poverty limit. What if next year something positive happens and the $1 per day citizens earn $2, whereas the $2 per day ones earn $10? As strange as it may seem, the two indicators tell the story in different ways because 1. Poverty has been completely eliminated now that everyone earns $2 daily or more, but 2. The income of half the citizens doubled, whereas for the other half, it's now 5 times higher. Therefore, there's currently more inequality than before, despite everyone making more money. Simple enough?